What is going on, my friends, and welcome back to part 2 of the Margex trading series. Now, today we're going to be taking a look at all of the different features and functions when you are looking to start trading, how you can open trades, close trades, and some of the different elements for trading that you may need. And so with that said, let's not waste any more time at all, and let's get straight into the video. So, of course, say it is now time to start trading. In the last one, we talked about the different things that you can use. You're doing your structural analysis, you're drawing in your lines, you're drawing in your trends, you're tracking your Fibonacci's, and now you're ready to start trading. Well, let's talk about how you can do that. Well, the majority of your trading is going to happen over here on the left side of the screen. And let me actually go in and make this just a little bit bigger, just so you can see a lot more as to what is going on here on the left side of the screen. So what you can see is you're going to have a couple things. At the top, you're going to have your main trade, which is, of course, going to allow you to switch in between what you're using. Of course, let's go ahead and use some Bitcoin for our collateral, right? And then also right here, you're going to have the crypto or the asset in which you are trading. So let's say if we want to trade Bitcoin, let's just go to Bitcoin. Okay, so now we have Bitcoin. Now we have Bitcoin. That is what we're going to be using to fund it, collateral, etc. Okay, so boom, ready. So now we have three options: limit, market, stop market. Now, realistically, limit and stop market are rather similar. Okay, they're going to be rather the same. And what a limit order is, quite simply, is that once a price hits a certain level, a certain thing happens. Okay, that's the easiest way to explain it. And so generally speaking, the way you can think about it is that if you're looking to sell a crypto, you'll set a limit sell order. What that means is, say, for example, if Bitcoin's at, let's say, let me move this screen over here. Say if Bitcoin's at 50,000 and you want to sell Bitcoin at 55,000, okay? Or maybe even open up a short on Bitcoin at 55,000. You'd set a limit sell order, meaning that once the price gets up to 55,000, that action is taken. Now, say, for example, if you want to buy Bitcoin, we're at 50,000, but you want to buy Bitcoin at 45,000. If at any given point we get to 45,000, you want to buy it, you're going to set a limit buy order. And that means that once the price goes down to 45,000, that order is going to take into place, that action is going to happen, and you're going to buy some Bitcoin at 45,000. So this means that if you're not looking to make a trade right now, but you want to prepare for some trades, maybe buy at some support or short at some resistance, you can use the limit function or the limit option or the stop market option in order to be able to take action on those trades, and you can kind of prepare for it better. Now, generally speaking, a lot of people do use this. Personally speaking, I use market orders most of the time. It's just my personal preference. And what a market order is basically is that at that exact moment, the platform that you're using, in this example, Margex, is going to try to find the best option for you to buy it. Okay. So say if right now I want to buy some Bitcoin and we're at 50,000, I'll set a market order and it's going to try to buy Bitcoin in that moment for the cheapest price that I can find on the order book. And it's going to try to take that action immediately. This usually happens within a few seconds. So if you're on the move, you're ready to go, you don't have time for all that preparation and all that safe stuff, boom, you just use the market order, which is very, very cool. Now, once you do get one of these orders going, you do have two options, okay? You either have the option to use isolated margin or cross margin. So let's kind of talk about what either one of those does. So let's kind of read this, then I'll show you a little bit of a chart or a graph that'll explain it a little bit better, okay? So for cross margin, it says that all cross positions under the same margin asset share the same asset cross margin balance. In the event of a liquidation, your asset's full margin balance along with any remaining open positions under the asset may be forfeited. So this means that if you're trading under, say, Bitcoin, and Bitcoin is what you're using as collateral, that's the asset, and you open 5 trades, the balance of that Bitcoin is being used for all of those trades. So if one of those trades that say it's like super risky, super high leverage, and you just get smoked out of the water with it, completely liquidated, and you had no protection at all, it will literally liquidate all of your Bitcoin and the other positions, as it says, cross margin. So it's crossing that collateral into all of those different assets and the asset itself and the different trades open under that asset. Risky stuff. Okay. Now, isolated margin. This is what I personally use. It says that you can manage your risk on individual positions by restricting the amount of margin allocated to each. If the margin ratio of a position reaches 100%, the position will be liquidated. Margin can be added or removed to positions under this mode. So what this allows you to do is say, okay, I only want to allocate $1,000 of Bitcoin to this one trade, and then it's going to give you a ratio. And of course, if you're within that ratio with the leverage that you're using, you can open up that trade. And at worst case scenario, if you do get liquidated with no protection, no stop loss, nothing like that, you're only going to lose that trade and the amount of the collateral that was allocated to that one individual trade. So it's isolated to that one thing, okay, rather than your whole portfolio. And if you want to see that on a bit of a graph, this is what that would look like, okay? Isolated margin, again, will allow traders to assign a single margin position margin. Any compromised margin will be isolated from other positions of a trader. Of course, a perfect fit for high risk margin trading. Of course, because if you want to just take a crazy risk or a crazy gamble on one trade, you're not putting all of your other trades at risk and the underlying asset at risk also. Net cross margin grants you the margin across all active positions in your portfolio, which is so risky, gives you a higher chance to avoid margin call and subsequent account loss. Sorry. And of course, it is great for traders who look to control multiple positions at once. So I would say cross margins, that should be used if you're a lot more experienced. Okay, just a lot more experience in general. I wouldn't be touching that if you were brand new to the scene. So now back here on Margex, let's go ahead and let's just choose isolated. So now what we can do is we can choose the amount of leverage we want to use, which is very, very easy, right? You can go all the way up to 100x for something like Bitcoin, or you can literally go as low as 5x, which is not bad, right? That's just very small, not doing anything too crazy. And that is generally what I recommend in general. I never really ever tell someone you should go 100x leverage long. That's crazy. But the leverage basically is just allowing you to multiply your gain. So if, say, for example, you're on 5x leverage and the price of the crypto that you own, say you own something that goes up $1, that means that the gains that you're going to see are for $5. But you have to understand that if it goes down $1, it's like you lose $5. So it's basically a multiple of whatever gains or losses that you generally would have seen without leverage at all. Okay, so a 10% gain is a 50% gain, but a 10% loss is a 50% loss. And now you can see why it is so risky. But say, for example, we want to go in on something like 5x leverage. Real simple, real easy. Now what we're going to choose is exactly the size of the trade. How much do we want to trade? So let's go in and just say 5 USD worth of Bitcoin. That's what we're going to do. And let's actually just go in. Do we want to do a limit price? Since we're going to do it in the moment, let's do a market price. But if I wanted to say only open up this trade at $60,000, I would just go in on the limit trade and I'll put 60,000 to buy the long. So that means that if the price of Bitcoin goes down to 60,000, a $5 5x leverage trade on isolated margin would have been open. So let's go ahead and move that to 5x again. Boom, there we go. Okay, so now you see that. But let's go over to just a market trade and make it real simple. Okay, so now we have a market trade, isolated leverage, 5x leverage, $5 trade. And let's go in and let's just buy it on the market. So let's just do this. Don't show this again. And let's just go ahead and press. Boom. So what you're going to see now is that the market order has been placed and the deal has now been opened. And what happened was that it actually moved on the screen, this blue line here showing where you opened up your trade at. And so that's pretty cool because now it allows you to know exactly pretty easily if you're in profit or if you're in a loss, just depending on what happens there. But now on top of that, what you can also see is that we also have this down here. Now, what this tells you is a couple things. When you open the trade, the asset that you're trading, the size of the trade, the amount of margin that you're using, the open price itself, which is of course the price that you bought it at, the current price, just giving you an idea of whether that crypto has gone up or down, the estimated liquidation price. So based off of the amount of collateral that you have and the size of the position that you have on the amount of leverage, at what price they expect that trade would get liquidated, meaning forcibly closed, and you lose the collateral that you put up. In this case, would be of course 0.125 Bitcoin. Now on top of that, and we're then going to be able to see something called a TP or an SL, and this is incredibly important. So a TP is a take profit and an SL is a stop loss. Now a take profit means, okay, if the price goes up to a certain amount, I want to close this position. And a stop loss says if it goes down to a certain amount, I want to close that position. That's for a long trade. Now for a short trade, it would just be the opposite. Remember, a short trade, you're betting that the market is going to go down. So a take profit means that once the price goes down to a certain amount and you're in a certain amount of profit, it's going to close the trade. Or if a crypto bounces upwards and you start to go negative, then you're going to see, of course, this stop loss close that position so that you don't lose too much. Okay. And I recommend any time that you use or that you trade crypto, you use a take profit or a stop loss. I really, really do recommend that. And so it's really easy to go in and add. Let's go ahead and let's say, okay, on this trade that we have right now, boom, we want to go in and we want to set a take profit level. So let's say that we think that Bitcoin's price is going to go all the way back up to retest this high. Let's call it $66,750 right here. What we're going to do is we're going to go in and add a take profit. So let's press set take profit. And we're going to go in and we're going to type in $66,750. And what it's actually going to do is it's going to give you a return on the investment. This is what they think that you're going to make. So at this is percentage wise. So at this point, if we get to 66.75, they expect that we are going to see a 20.9 to 20.98% return. And let's go ahead and let's just confirm that bad boy up. And as you can see here, boom, 66.75 has been placed. So now we know if we go up to 66.75, we're going to see this position close at what should be around a 20 to 21% gain. Now let's go in and actually let's set a stop loss. Now, to set a stop loss, what we're going to go in and do is we're going to just pick, okay, where do we think that this is going to go down to if we are wrong? So let's say, okay, boom, current price of Bitcoin is at 64,000. We think that if its price goes below 62,000, that we're wrong and that it's likely going to continue lower. And so we want to close that trade. And so all you're going to do is you're going to go in, you're going to type in the same thing like you did with stop loss, so 62,000, and it's going to say, okay, well, if this does happen, then we're going to close a trade, and you're going to be at a loss of roughly 16% to the downside. Now, a cool thing is you can only close a part of the position. So say if it goes down to 62K, you only want to close half the position. You can then go in and go to partial position and then only close half the position, which is really cool. But let's just go with the full position and let's press confirm. And now what you can see here is our trade is ready to go. We have a trade open. Of course, remember, $5 trade, 5x leverage. We open it at 64,000. We have a take profit level set at 66,000, 66.75 thousand right here. We have a stop loss set at 62,000. So now realistically, we're pretty solid. We're either going to make a 20% gain or lose 16% of this position. We can't blow our entire account. We're on isolated leverage, meaning we're not taking a risk on all of our assets or anything like that. And no matter what this thing does, we should be okay. This is how you minimize risk when you're leverage trading. There's really nothing that can happen at this point. I guess unless my stop loss fails or something like that, which just does not happen generally, that would cause me to lose a ton of money or take a huge loss on this thing. And so at that given point, now we are ready to go. Now, say if we want to just close this bad boy, you do have a couple options. What I generally do is I just use this function down here. So you have the market close or the limit close. Limit close just means that if the price gets to a certain level, it'll close it, or if it falls to a certain level, it'll close it. But generally speaking, since we have a take profit or a stop loss, you're not really going to need that unless you just want to cancel the trade in general. So what we'll do is we'll actually go over to market close. And what you can do is you can actually decide how much of the position you want to close. So let's say we want to close 50% of the position. Well, you drag the scale there. Well, let's say we want to close the entire position. What we'll do is we'll move it to 100%, and we'll quite simply just press. What you can see here is that it just closed out the position. Absolutely done. Nothing else needed to do. You've not taken any more risk. It is all gone, moved over to your position history. Now you can see I was actually doing every now and then I just test out some of the different functions on this is my secondary account here. But as you can see again, that trade is now here. We opened it today, April 25th. And of course, we closed it here. And I actually tell you exactly how much P&L was made. Since we did close it at like a flat amount, obviously we didn't lose anything. But right here, for example, say if we would have made some money or lost some money, it would be right here just showing you the profit and loss there. Now, you can also see your order history, but of course, we don't have any order history as we don't have any active orders. And you're not really going to necessarily need that, especially if you're kind of sticking to the basics of leverage trading here. And so what you can see here is that it is a very simple, very easy, very, very subtle. And that's exactly what I like to see. I don't like it to be too complicated. I don't like it to be all this crazy stuff at once. We can quite simply just see, okay, open positions. How do you open it? Limit, market, stop market, isolated or cross, how much leverage, how much of a position do you want to open? How much money do you want to put in that bad boy? And then overall, do you want to set a buy stop or set a sell stop? Do you want to go in and short the market or do you want to long the market? That is so easy. Tracking your positions down here, so easy and so amazing. And so with that in mind, that's a basic tutorial on how I do use Margex for my leverage trading, whether it's isolated or whether it's margin. In today's episode, we talked a bit about how to open positions, how to track those positions, and how to add some things like stop losses and take profits. And in part one, we talked about all of the different features and functions of Margex that you can use. Now, as I mentioned before, in part three, we're going to be going over exactly how to use the copy trading part of Margex and what are some of the different approaches and ways in which you can take that. And so make sure that you do stay tuned for part three if it's something that you're interested in. And I can't wait to see you all next time. Peace out, everybody.